I got a couple prefaces for you as we move into this, and then I will tell you even one thing pre-preface, which is to keep this short. I don't have as many examples as I normally would. I'm a huge fan of like say something and then show something. So like here's examples, here's evidence, here's how that works in the real life. Here's an example of a back test that demonstrates that principle. Here are some actual trade results, etc. This we're going to stay at the surface level and go through it, and I think it will still be valuable the way it is. All right. So 9 rules for better trading. These are not cliche rules for any trader to sustainably make progress. So trying to take a different angle than just what you would find in your, beginner trading books and things like that. Really, the preface will discuss more about that too. So preface, tactical rules, which I talk about a lot, are not discussed in this. And tactical rules are specific to decision making. That is when to buy, when to sell, how much to buy, where to set a stop, strike selection, strike width, filtering for events, don't trade your earnings, don't trade if VIX is above a certain level. Those are all tactical rules that have value and guide traders all the time and what I do. Strategic rules, higher level rules, are what we are discussing. And those are higher order, more like principles, and they are guiding the tactical rules. So the use of tactical rules, no matter what type of trader, if you are a systematic trader, systems, rule-based trader, nobody is 100% rules-based. Do you know why? Because you have discretion about what rules to follow and when you're going to stop following them, right? So we all have this level of discretion. So this is like a higher order to even a strategic systems trader. And this is not a complete list. It's simply ones or rules that are, I feel, more overlooked and have been more meaningful to me personally in my development. As I said, feel free, ask questions throughout. I'd rather not wait till the end. You may ask them now, and then we can hop in and answer that. So I'll see the little pop-ups. Where can we find tactical rules that have an edge? If you look up my YouTube channel, just look up Edge Navigator or my name, Andrew Faldy. I have a few on there. So there's some that work that I've shared publicly for free. So one is an RSI system that I pretty much share for free at all times. And it demonstrates how you can get an edge out of a set of rules. So if you want to look those up, you can find them that way. And then the more complete answer is and by the way, if I didn't say the question is where can we find tactical rules that have edge? The other way, the more complete and hard-earned way is to come up with ideas and test them by back testing, either automated or manually. And that's another way to find them. So you can get them from other people, you can buy them, and you can develop them on your own through experience and asking questions or observing the market and testing your theories. So this is not a complete list, is where I left off, I think. Ones that have so it's even in the name. I intentionally, for the grammar enthusiasts out there, who are like, why did you start your title with a numeric, a number? You should have written it out N-I-N-E. I should have spelled out the word 9. You shouldn't start with it. I did it intentionally for those who it would irritate, because it's not called the 9 rules for better trading, because there are other rules, plenty of other rules, right? These are 9 rules, just 9 rules, not all of them, not complete, but ones that I felt were important to bring up today. So here we are. Let's hop right into it. So number 1, and these aren't in order specifically, so we'll just dive through them here. Risk should be measured in at least 3 ways at all times. And not first, but the 3 that are often overlooked or not fully understood or used always as they should be: average risk per trade, cumulative portfolio drawdown. I'm gonna read, since this isn't been PDF'd yet, I'm going to go ahead and tweak it as we go. Cumulative strategy drawdown or specific asset drawdown historically. So if you have a series of trades that net lose, you could have like an average loss an average win, 2 average losses, an average win, 3 average losses. And so you don't just say, hey, I'm only risking 1% per trade. Well, what's the cumulative of the equity curve on a drawdown period? And tail risk, or black swan, as Nassim Nicholas Taleb introduced to us, if you're familiar with him, and that's your extreme loss scenarios. So let's explain these a little further. Average risk is typically very small percentage of your capital. Example, 1% of your portfolio per trade. Well, I said I wasn't going to be cliche. So here's where the non-cliche part comes in. But it does not need to be the same for every trade. If you feel like, that's like the rule should be, oh, it should always be 1% per trade, or you've heard other people say that, oh, always risk the same amount for every single trade. Not all trades are created equal. Not all underlying assets are created equal and have the same risk reward opportunity. Things, there are, or you may have something that has produced a lot of gains for you over the years, and you want to add more to it because you want to reinvest in that specific thing. We're going to talk about proper ways to do that, or more appropriate ways to do that in a minute. Cumulative drawdown tracks the maximum loss from peak equity to your drawdown point, and that helps understand your risk tolerance, but you can't understand your risk tolerance about drawdowns, like cumulative drawdowns, unless you've analyzed it, unless you have that data. So make sure you have that. But it is not guaranteed. The past drawdown is not guaranteed to be the worst drawdown in the future. And we're going to go even deeper. And drawing down more in the future does not guarantee that the strategy is invalidated. Okay? Be more specific here. Okay? If you say the past, max cumulative drawdown in this strategy was 8%, 9, 10, 20, I don't care, whatever it is, and you just size appropriately to that. You say, well, if it was 15% in the past, say if I get to a 17% drawdown, it's failed and I have to stop. That would not be the appropriate way to look at past drawdown. Or say, oh, I'm totally fine if it draws down that much, or even just a little bit more, and then I'll, just quit trading or whatever. You need to be prepared to go through more, and we're talking more about that in a minute. And tail risk, or black swan, etc., are those extreme rare events. Very key here, very key. Do not depend on past events in the same asset and that strategy, or that that study, or whatever you have available to you, especially or with a limited history. So I had that challenge in the past. I actually identified that I had bad data or incomplete risk analysis, and I actually stopped trading my biggest trade that I had the most funding for. I stopped it before anyone else told me to stop, because I realized the risk that I was identifying was only based on a 10-year, which at the time I thought was a lot. I was like, I have 10 years of trade results for this system strategy, and this is the max drawdowns ever had, etc. Okay. And then I kept hearing about, well, what about 1987? What about these other asset classes that had much bigger tail risk than the last 10 years? So the same asset further back in history beyond the data that I had a bigger outlier risk. If I modeled that and simulated that, would create a much bigger drawdown than I expected or was showing in the data. So I had the limited history in that asset class, and I was not considering what has happened to other asset classes. So some examples, or to make this clearer, consider extremes in other markets. So if you have a system that you're studying, or you've back tested, or you have the data from a back test. I just want to double check we are recording. Yes, okay. And you say, it's got, the worst case was, this one time it had bad earnings and it dropped 10% overnight or something, 15% overnight. You say, well, have other things done worse than that? Have other things had bigger drawdown? Have other systems and strategies had bigger drawdowns in events like that? So there are plenty of assets and strategies that can lose 20% in a day. And it will do it after not having done that for 10, 15, 20 years, or 50% in a month. Or if you consider the tech bubble, things that went on to actually produce gains, or some of these just were super overvalued, you could lose 80 or 90% over a year, or some period of time, many months or a couple of years. And if you want to really, get your mind right about risk, and really like be, is humble the right word? Sobered up. I don't know what the right word is there. But SVXY, the inverse of VXX, sorry, actually more of the inverse of UVXY, because I think it's leveraged too, lost 91% in one day and never recovered from that. So 91% in a day on an S&P 500 based derivative of a derivative, pretty messy instrument, but really you're like, it's based on the S&P 500. The past trial, like the worst it's ever done is, down 10% in a day, or down 15 or 20%, something like that. And then it came back, right? I'll be able to get out and get back in and do this. Nope, 91% a day with no recovery. It has, somehow they allowed that to continue trading on and working. So there's that. So are you really considering tail risk in your strategies? So let's reveal number 2. And I'll have to pick up the pace to follow my timeline that I offered. Probability of profit is meaningless without context. Always compare it to the average risk to reward ratio to assess true viability. There's too much attraction in general on retail trader basis for higher and higher and higher win rate, or higher and higher probability that this trade will end in a profit. Too much emphasis on that. A high probability of profit with poor risk reward, like 90% win rate, but when that 10% comes, you lose $10 for every $1 you gain on the other trades. It's not going to make you any money in the long term. And really worse is people say, well, 10% is pretty rare. I'll climb back out, whatever. Say maybe your numbers are a little bit better than that. Or you say there's a lot of times it loses, but it's not always all 10. Sometimes it's 5 or 4 or 2, and I take that stop loss or I get out faster. Okay, great. But what about when it does lose $10 for every dollar gained twice in a month? You say, well, that's not, yes, it is possible. It absolutely is possible. And it's happened to strategies that never experienced it before, went on for 10, 15 years, and then that happened. And are you prepared to really go through that? Lower probability, however, strategies can be highly effective with favorable risk to reward ratios. I'm not throwing away high probability. I just think there's way too much emphasis on it, and way too much like, oh, if it's not at least 60 or 80%, why am I even looking at it? Please don't ignore the low probability strategies. They can be very effective. You just need the right numbers. You need the right full context. So that full context is a strategy with a 40% win rate, for example, 1 to 3 risk reward, risking $1 to gain 3 on each trade. I used to be like, oh man, I got to get a calculator out. It's actually pretty easy. If you just always take the win rate and just divvy it up into like 10 trades, so just round it to the nearest, oh, it's 43%. Call that 40. Okay, 40% win rate. That means there's 10 trades, 4 winners, 6 losers, right? So 4 times your gain on average is 12. Easy, $12 over 10 trades per unit, per share, whatever. And then 6 times the $1 risked or lost is 6, right? So 6 losers adding up to $6 in losses. 4 winners times 3 is 12. That's 2 to 1. 2 to 1 expectancy. Okay, maybe not the exact way to calculate that traditionally, but it is correct. Or you can go even lower, where many of my strategies running are in the 30s on win rate. Okay, with a 1 to 5 risk reward, which is absolutely possible when you get into those, because you buy, and if it's not going the right way, you're out. It's quick. Okay, and then if you catch a winner, you let that thing ride for 20 times longer. Okay, I don't know why that sounded weird. 5, 10, 20 times longer. And so you can have much bigger average gains. So obviously 3 times 5 is 15. 7 times 1, which is the remaining, the losers, is 7. It's more than 2 to 1 expectancy. Okay, and here's a really big one. If you're like, I really just want to win often. I really just don't like to have 70% of my months losing and 30% winning. Well, that's if you come from the world of like monthly campaigns, or like I'm going to put the trade on and take it off in a month, anything like that. Because you gotta realize when you go to lower probability, losers are short-lived. And so time spent winning, the last video that I put out, sent out the recording, it's on YouTube. has a very clear example of this, where you have like 7 losers in a row that last like 2 weeks. And I was like, would you take trade number 8? And then like number 8 went on to be a big winner. That one win that lasted longer than almost all of those trades. And it might have been the next 2 winners. It was like a win, a small loss, and another win. Those 2 wins were a longer period of time spent winning than all 7 of the trades prior to that lost. And that was just a really specific drawdown period. That isn't normal. Like it was worse than normal, but it was still, after the 3 months of experience, you would look back and say, that was great. Let's do that again. All right. Recent profits can create, there was a question. So where are you going to, I'm going to just say I answered that, then I won't see that anymore. Okay. Recent profits can create a false sense of security, leading to overconfidence and risky over allocation. So one example, like I had the temptation to, in this was like, I've had some like good Tesla trades, good NVIDIA trades, great Bitcoin trades, etc. And so like, let's say you've been trading like 1 Bitcoin, right? And you're up tens and tens of thousands of dollars, and you're like, all right, well, I had the one, equivalent of 1. I should keep that rolling now that it's at $100,000, right? Well, at some point, you may want to move that money around and do a little bit less than 1, and that's okay. You're like, but what if it goes to $1 million and I missed it? A lot of times that doesn't work, all right? So diversify profits across multiple strategies or assets instead of concentrating on a single high-performing one. Doubling down on one approach can be less reliable over the long term. This is, if I were to slow this down and get one big example, I would show in TradeStation, I can do this. I can reinvest the gains of a strategy back into the size in a single back test. And so it will create an exponential return chart. And a lot of times it's super exciting, really amazing like returns. I started with $10,000 and I ended up with $1 million of total return just by putting the money back to work on every single trade. There's a lot of times where like if the strategy really stops working, the asset tanks, and you just get a lot of whipsaw, you can end up much further below in a big drawdown than you would have. And it does scale back down, but it can happen so fast on a few trades that it'll actually pull you down farther than if you just like stuck more stable or kind of spread the money out a little bit. So review before you add size to something that's winning. Review the past drawdowns at the new size and ensure you're prepared for that. If you're like, hey, I was doing this trade all along because I was comfortable with a 5% drawdown on my portfolio overall out of that one asset, okay? And they're like, well, I just made 10% of my whole portfolio in that single asset. I can now go up to this size. Well, are you going to triple your exposure to that single asset and strategy? So really analyze that and be sure. Now here's a little, I really like this one. I try to do this, but I don't always, and I should do it more. So kind of speaking to myself, develop the discipline of waiting for a drawdown period, either even just a day, a week, a month, a full month where, okay, things have really been choppy and it's just nothing's lining and none of the stuff's really making more than the losers. And so like, I'm down this month, whatever, that happens. Wait for that time to come before adding size. So you're like, hey, I'm up a lot. Last year was great. Any type of momentum type trading was just fantastic. Even if you had a mix of strategies, that stuff just beat out everything else. It was great. Okay. A lot of systems and strategies made 20, 30, 40%. And very, very good. So you're like, all right, it's November, it's December, it's January, things are still good. Actually, recently there's been a little choppiness, and you're like, and every time you're like taking profits or you're looking at your camera, like, man, I can add more to this. Well, if you wait till you're down, it's kind of like buying the dip. You're like buying the dip on your strategies. So I just want to, let's go fast. I don't want to say I'll go fast, and then you won't believe me next time I say it. Execution is as important as strategy. A great strategy, poorly executed, will underperform a mediocre one with flawless execution. So true, so true. Use tactical rules if you're prone to or recently experiencing negative emotions that are affecting your decisions. So if you're discretionary and you're having a hard time lean back into some simple rules. Just get yourself back into kind of like a steady state of like, I'm just going to follow the rules and I'm just going to do that. That's how I had my big turnaround originally, is I was just all discretionary, all negative emotion, and then I just flipped the switch and it all got better. Now I could have picked a bad strategy, but I guarantee you I would have done better. Even with a bad strategy, I would have done better than what I was doing. Prioritize simplicity in strategy design. Complex strategies often increase the likelihood of execution mistakes. Okay, that's pretty self-evident. Well, the solution to that, you don't always have to go simpler. Simpler really does do some amazing things. Complexity in system design is often just trying to overfit the past and doesn't work in the future. There's room for complexity, but the more complex it gets, that's where you want to switch to automation or tools or something to ensure that you're not having to do a whole lot of work and not miss little things all the way through. There's some of the strategies I run, like, if I printed it out on a piece of paper, it'd be like a page and a half of code. And like if that was, and I'm running it on 20 stocks. If I had to run it manually 20 stocks and follow those rules before every trade, and really every single bar you got to check to see if something's going on, and some of them are hourly, I would have errors all the time. And that's why even when stuff messes up, like if I get offline or something freezes or I turn something off on accident or whatever, I don't care what it is. Something doesn't fill, like the rare times that something happens, I just immediately say I would have done 50 more errors than that in the period of time it took to get to that, probably 100. Higher frequency trading amplifies trading cost ratio. So higher frequency is justified. Now, is that clear enough? Higher frequency trading. So like trading a 1-minute chart with one set of rules will often not work in the real world or anytime you test it with reasonable slippage assumptions. Without slippage assumptions, it could look amazing. But with slippage assumptions, no version will work. Okay. And in the real world, with real slippage, it will not work. You will lose money. And then if you take that same exact strategy, every rule is the same, you go to a 10-minute, it works better, but still most times not going to work. Then you go to like 15 or 20-minute or 30-minute. Now it's going to actually start working, but it's really choppy compared to if you go to hours and days, hourly charts, 90-minute, half day, day. You do those charts, then most things can work because slippage becomes such a tiny fraction of the average trade. Because, do I have it? Yes, I think the second point says it. So let's just go back to this. Higher frequency is justifiable when the movement over short intervals is as high or higher than other assets on long intervals. Example, Bitcoin and fast-moving stocks often move a few percentage points a day. Okay? I'm going to add an edge, I guess. Offering opportunity to buy and sell over the course of hours or days, sometimes even minutes if it's really moving fast. While slower moving stocks and ETFs, blue chips, all those rarely move 1% in a day, meaning those trades may need to be held for days or weeks to achieve the same cost ratio as something moving very fast that you could trade in and out of multiple times in a day. So that's where like day traders can do 20, 50, 100 trades a day because they're only going in and finding stuff, most the really good ones, they're only finding trades in something that's moving 5 or 10 or 20 or 30% that day. So they're capturing movement that would take months or years for a slow moving stock or ETF. So they can trade it lots of times because they condense all of those opportunities and all that movement and all the ins and outs into a single day, but their cost ratio per trade is the same. Often we're like, I want to day trade too, so I'll go trade E-mini or SPY, and you're going to be behind most of the time in that. And a lot of it's because of cost ratio, and that's not really ever calculated. And the broker is never going to spend some time to explain to you why your over trading is not good for you, because it's good for them. Do you think 0DT options trading is a waste of time if traded on index? Absolutely not. Anonymous attendee. I trade 0DTE right now, and I do it with credits and debits, and I do it on full automation through Option Alpha. I don't know if there's some link where I can get a commission for that. Anyway, I don't care. Option alpha, I do. So no, zero DTE is fantastic. A lot of stuff works there that does not work even at like on 5-day options, even 2-day options. You know, zero DTE can create is great stuff. So don't stop looking at that. Historic returns can be observed in a single moment. I can show you a 10-year equity curve that looks gorgeous. Again, I wish it was a better example. Go watch the last YouTube video. It's longer. You'll see all this stuff. Historic returns can be observed like that. You can, in a single picture, see the equity curve and say, that looks amazing. If I had that experience, if I knew I could just take that equity curve and apply it to my account and compound it, I'm golden. I'm good to go. I don't have to do anything else. It's great. But don't overlook the length and emotional toll of the past drawdowns that just hide. It hides in the data. The flat period, the drawdown that lasts for weeks and months sometimes, that's small. You didn't really notice it compared to the explosive gains that happened before and after. But you don't see that. You just see the single picture of from here to here. And you didn't see the drawdowns as far as like how they really felt. Okay. So you must be prepared to endure them in real time, or you're going to get excited and start doing something and quit, even though it didn't break, even though it was fine. I'm going to put, I'd say I answered that. So I know when a new question comes in. So look at the max drawdown duration. You got max drawdown. You know about that. We talked about that. The duration of the max drawdown in however long it is, weeks and months, whatever it is, for every single strategy to gauge the psychological challenge of going through and continuing to stick with it. All right. So here's the actual exercise would be to think long and hard. Some people call that meditating, right? Meditate about your experience trading through those drawdowns, sticking with the plan, and experiencing that push to a new high P&L after sticking with it. Okay. There are plenty of times I'll start a new strategy because everything looks great. And guess what? It looked great because it went through a great period. And then I step in just around the time it's not going to work for a little while. And because of automation, I don't really have the emotional like annoyance of dealing with that. But I do know and I understand that some things won't work for a long time. You know, some of the assets are just not going to move for a while compared to other things. And if I'm like, well, I'm done, that doesn't work anymore, I'm going to go over to this. What do you mean anymore? If the back test showed that it doesn't work sometimes for 3 or 4 or 5 or 6 months, and it hasn't worked for 1 month, well, who are you to say it stopped working if it's doing exactly what it did in the past? Be prepared to follow that so you actually get the result. All right, so instead of quitting on the strategy that is drawing down by a normal amount, okay, diversify your approaches, use that negative energy and like convert it over and say, all right, this isn't going to always work for me. So what else can I add? Not switch, not jumping back and forth all the time, and maintain all alternative sources of income and ensure you can endure dry periods without letting doubt derail your overall plan. All right, you guys are doing good. You're listening faster. We're going faster. Aim for robustness over optimization. Strategies should perform well across variations and similar markets. So a robust strategy delivers similar, not the exact same, but should deliver similar results across similar assets. So if you have an S&P 500 strategy, then you go test it on NASDAQ, which is a little different. It's more high beta. I actually say it's quite different. But if you test it on the Dow or maybe Russell 2000, you know, which have different growth and decline periods, okay? The overall concept of the strategy should work. It should work. Maybe it's not as good, but it should work over there similarly, okay? It should demonstrate edge over there. Rules should remain effective in a system or strategy, even if the parameters are adjusted a little, okay? So if you're like, hey, the 11-period moving average and the 6-day breakout and a 0.9% stop loss works really good. Okay, why is it so specific? I don't care about being specific. That's great. But, you know, if you switch the 0.9% stop loss to 1.2 and the 11-period moving average to a 14, does the whole thing fall apart? If so, you found a key that unlocks a door that goes nowhere. You unlock the past and you can't go back in time and make money. That'd be great. But that's not what we're trying to do. We're not trying to build strategies to hop in a time machine and go back and get money out of. We're trying to find things that are robust. Prioritize simplicity and universality in your strategy, overfitting to historical data per instrument. So going there and like optimizing the settings for this stock and then optimizing the settings for this stock is not probably going to, it's not. I'm going to go out on a limb and say it's not going to improve your results in the real world. It might make you feel better before going live, and it will create diversification, but it's not going to optimize the future. Evaluate the value of your time in trading, factor in opportunity costs, consider outsourcing, use automated tools, and avoid burnout to protect your long-term performance. So, if you're like spending hours a day trading or looking at the markets, or me, like I like look a lot of the time and like roll my system, like I'm over here, that's over there. So I'll roll over there and take a look and come back. Sometimes I realize like I have the automation for a reason, so I have time to do other things. Okay. So calculate your hourly earnings from your trading. What's your total P&L divided by the time spent, including execution, prep, back testing, all that. But keep in mind, however, the opportunity to compound and scale and maybe raise money is not included in that calculation. So maybe you're like, well, right now I'm paying myself, $9 an hour to trade, based on all the time I spend back testing, studying, whatever. Maybe that's what the last year gave you. Maybe it's $100 an hour, whatever it is. But know that number. But don't just say, oh man, I did all that work. I probably was really only making like $15 an hour for all the work I was doing trading. So maybe I need to figure out a way to be more efficient. If you're trading at a small size and you think, well, I have a lot more money I could put behind it if I was more comfortable, or I could raise money, or I can work for a prop firm, or I can compound these returns and I have decades to go. So I can compound and add, and I have other income where so include that in your understanding of like this stage of things, but make sure you have a good sense. If you're like, nope, I have everything I'm ever going to have in this account, and this is my hourly rate, you may want to figure out ways to be more efficient with your time, or consider opportunity costs. Automate repetitive tasks like screening trades or setting alerts, using APIs or trading platforms. That's stuff I like to talk about. There'll be plenty of opportunity in the future if you stick around to get in work groups and get tools and stuff like that for that, or you can learn on your own as well. Consider outsourcing tasks like data analysis, research. That's newsletters. That's trade alert services, all that kind of stuff. Like paying for those things to get your time back so you can use that time in other productive ways that make money especially, but are also just give you more life, might be a good trade-off. Probably a good investment. And even parts of strategy, actually trading, if you have, I'd say if you have hundreds of thousands, that's typically like over 100,000 to millions, teaming up with a trader or an advisor who understands what you're doing and will support you in that or do it for you, it doesn't have to cost a lot either to do that. If that's something you're interested in, reach out to me. That has to be a separate conversation than this for compliance reasons. Trading success is never permanent. I was told by a trader who was actually not very great, but was better than me at the time. He was like encouraging me and saying, once you figure it out, you got it. You'll never lose it. And I was like, wow, whoa, that's great news. I was so excited. I'm like, all right, I'm like right at the edge. I've turned the corner. I'm starting to be profitable and I'm kind of honing things in. And he'd been doing these things for a while. And he's like, yeah, man, once you learn how to make money, it doesn't go away. And it does, actually, I learned. So trading success is never permanent. Stay ahead by continuously learning, adapting, and refining your skills. So dedicate time weekly, especially when you're making money, to looking at other strategies and systems. You're making a lot of money because the market's going up and you don't have a lot for the downside. Spend time learning how to make money on the downside. It may feel like, why am I doing that? You know why you're doing that because that's coming, right? Dedicate time to study market developments. So that's new stocks, things that IPO'd in the last few months. How's it looking? How's it shaping up? What does it look like? What type of asset is it? Is it fast moving? Is it slow moving? Like, is it actually just going down? Whatever's going on there. Emerging asset, this other just said that reading, trading books, attending webinars like this. Okay. I don't have to tell you that because you're here, right? But keep doing those things. Backtest, manual or automated regularly, especially approaches that diversify, hedge, and protect what you already do. I spent probably 2 years, trying to just dive deeper and deeper and deeper into the one thing I was doing, to make it better and better and better. And that was a mistake, and I should have done this. And I hope you do this if you're not. is to like look outside of what you're doing and look at things that are contrary and opposed and a different worldview oriented to what you do. So if you're like a market neutral type person, like take that hat off for a little bit, put the hat on of like devil's advocate, say, if that actually was the worst idea in the world or unreliable or going to have a lot of hard times, how can I make money believing that? And then learn that and do that too. And it isn't going to be like the opposite. If you trade iron condors, it's not going to be like, well, I should buy iron condors instead of selling them, because that's probably not the best way to make money on moves, especially on an SPX type trade or something like that. I know that's where a lot of you come from and where I've gotten connected to many traders over the years. So that's why I bring that up as an example. But find ways that you do make money when that loses and really get to know it and put off all the stuff you knew about like, I like iron condors because it's 80% win rate, or whatever on the system you have. And I'm looking at all these momentum systems and they're higher volatility. They don't feel like income trades. They lower probability per trade. Yes, that's how it works. And you have to like embrace that and say like, how does that work for me? Okay. It's very powerful, big shift, very important to do if you have not already. Engage with other experienced traders, especially ones doing things different than you. Exchange ideas and perspectives that challenge your current strategies. All right. So now that we're done, only a few minutes past what I said. I would have really been sad if I said 25 minutes, 25, 30 minutes, and it was an hour. So we got that done. So I'm going to hop into the chat and give you this link. If you're watching the recording, there'll be some other way for you to get it because I'm sure you don't want to type that out. And I didn't have time to finish a fancy URL for you all to go to. So that's it. No other questions came in, and I promised a short, sweet thing. So depending where you are, I picked 1 o'clock. Over the years, I've learned that kind of works best for like everyone from Europe all the way to California. So doesn't work for anybody east of Europe. Somebody raise a hand. You put in the chat or Q&A panel. I'll stick around. Read through the names here. Danny, good to see you. I know a lot of these names. Kirk. User 1, good to see you again. Here it is. Type. Oh, here they go. I probably chatted to myself. Yeah, that's why. I pasted it to host and panelists for some reason. That's the default. There it is. You're welcome, Charles. Thank you. I see you guys popping in. There you go. There, the little icons are popping in. Yes, it does. Thank you, anonymous attendee, for all your contributions today. Thank you for that. And yes, I could have shortened the link too, but I was going fast, and I know I'm going to do it a different way afterward. And I'm going to email it out. The recording, and they'll be easy to get right next to it. All right, so that was the main issue. All right. Well, that's it for this one. And thank you all. Nothing to buy. If you want anything, you want help with something specific or anything, you can track me down and I'll point you in the right direction on something that could be a good fit for you. All right, that's it though. And I'll talk to you next time. See ya.